Get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
Hey, Bruce, how we doing, buddy?
Doing great, man. Happy Monday.
Yeah, happy Monday to you. Happy Monday.
All right, let's
We're
get started on some news here right away.
we're approaching the end of the month, right? We're winding down here, and I got to tell you, with rates are like a big topic of conversation right now. There's a lot
Always
of
are.
changes going on. And somebody asked me the other day, and we teed it up last week, but like, what's the difference between the interest rate and the annual percentage rate? Because there seems to be a big disconnect.
There's a lot of confusion in the market with what that is, but let's just break it down. I put together the most simple Word doc you could ever imagine. So if you can bring that up on the screen. So here's what we got. First of all, your interest rate is your interest rate. What you're quoted is a rate. Now, the APR is going to take into consideration any other fees or closing costs that may be included in that origination, closing costs, anything that could be added into the loan. So let's just take this simple scenario over here where we have $100,000 loan amount at a 7% rate. Okay.
Okay,
So your 7% rate would yield interest only of $7,000 per year, right? That's
yep,
7% interest rate. But if you paid $1,000 in closing costs, then you paid $8,000 between interest and closing costs. Does that make sense?
yep.
Then if I take and annualize that, your APR would be 8%. That's all it is. Now,
Okay,
but the thing of it is that the closing costs are one time on a mortgage. They're not a reoccurring fee.
right.
So they take that lump sum and they annualize it, and that's what your APR is. So if you had an interest rate of 7% and one lender was charging you $1,000, your APR would be 8. But if the other lender was charging you $2,000, your APR would be 9. So you'd be better off to go with a little lower APR. Does that make
Gotcha.
sense?
Gotcha. Yeah. So is that it? But you're doing this on a 1 year example, right? But it's not, you don't pay those closing costs every year.
Well,
So,
it's still annualized. It's an annualized interest rate, and that's what the APR is, an annual percentage rate. So it's going to take that bulk sum and it's gonna add it into the total cost and divide it over the loan.
oh,
So
but does it divide it over the 30 years if I'm doing a 30-year mortgage?
your APR example is going to be it would be divided over 30 years. That's
Gotcha.
correct.
Gotcha.
It's
Yeah.
actually it's going to be divided per day,
Per
right?
day.
So
Yeah.
it's a
Yeah.
per diem
Right.
that would ultimately, but for illustration purposes, this is the easiest way to illustrate it.
I got you. I got you. Yeah.
Otherwise,
But
otherwise we are trying to divide that money over 360 months, right?
right.
And
Right.
then divide that per day.
Well, and then you
So
got to realize that you probably aren't going to carry the mortgage for all 30 years. So when you pay it off in
that's a
five to
good point,
seven,
Tom. That's a really good point because people look at that and they think, "Oh, I'm going to pay this much money over the life of the loan," or they'll look at the truth in lending statement and they go, "My God, I borrowed 400,000, but I'm paying back 600." Well, in most cases, you're not going to. Not
right.
very many people live in a home for more than 7 years, and in Florida, since we're more transient, it's about a 5-year period of time on average.
Okay. All right. Fair enough. Well, that's a pretty good explanation. I think because one thing I've noticed is that, like, with different loan programs, there might be a different rate, right? Like, so like you'll see the interest rate is the same, but the APR is
The
different
only
if you're
way your
doing one
rate
loan versus another.
the only way your rate can be the same as your APR is if there's no closing costs at all.
Yeah.
Now
No. I mean
you have to
yeah.
remember that some things are included in an APR cost and some things aren't included. And
Gotcha.
that gets a little esoteric, but you have to look at things like a VA funding fee or an FHA MIP upfront. All those things can throw the APR off and they change your APR, but it's unrealistic to really look at the APR versus the interest rate. Focus on the interest rate, focus on what the lenders actually charging and closing costs, and make a determination when it comes to which is your best deal.
So bottom line, if I'm considering buying a house and getting a mortgage, and I've got options, if I could go conventional, FHA, VA, whatever I can, right? Then I really should sit down and kind of take a look at all three with you or somebody, right? Just to say, hey, which one's best for me today in my current situation, right?
Well, you want somebody that's going to explain things in layman terms, okay? We don't have to dummy it down too much, but clients don't want all this weird talk with acronyms and lingo. They want to know plain and simple, can I compare this to that? And what's the best deal for me? And sometimes I got to be honest with you, price is the way to go, but other times it's not. Like I look at lenders that are throwing out this, particularly internet lenders, they throw out these lower rates, but by the time you're done, even like Rocket Mortgage, they're the biggest mortgage company in the country right now. But when you sit down and compare it to what somebody like me that's a direct lender can do, their rate might seem lower, but it's actually not lower.
Well, that's because the APR comes into play, right? And all the charges that they're going to have.
Right.
So
You want to, and listen, here's the fact. I don't like clients paying too many points right now, even though they like to because they can get the rate down. But the fact of the matter is almost everyone that's buying a home right now, you are going to refinance within the next 24 months. I guarantee you're going to refinance. So if you're going to refinance within 24 months, and the difference in paying those extra points has a 36-month break even period, then don't do it. Pay a little higher rate and
right.
refinance. We might even see rates dropping down within 1 year. It's very possible.
Okay. All right. Fair enough. So now this is a big topic. All last week it was a big topic. On Fox News, and I read a thing in the Post, and this loan level adjustment thing that we've talked about it in the past, but now all of a
We've
sudden it's
featured
bad
this.
news has come out, right?
I've featured it. I've sent out blasts to my realtors, letting them know this was coming. And don't ask me why, but this week they all started to call me going, what is this? I'm like, I've been telling you about this for over a month
I
and
know.
you're just getting it off Fox News. So pay attention to my blast because they keep you ahead of the game, not behind the game. So here's the reality of it. Fannie Mae and Freddie Mac are trying to help the individual families that want to buy a home that may not have great credit or perfect credit. So a below 680 credit score. Now, Fannie Mae, you're penalized. Even if you had a 750 credit score, you're not going to get the same pricing as a 760. So
Right.
every increment of interest rate or credit scores has a different pricing model to it. And Fannie Mae has dialed this down, and Freddie Mac, and they have determined that they want to now subsidize the lower credit score borrower that has less money to put down. Now, where's that money going to come from to subsidize it? Where do you think that's going to come
It's
from,
going to come
Tom?
from the people with good credit
So
that
if you
put
got
more
an
money.
800 credit score or 760 and above, and you're putting 20% down, you might not get as good of a rate as you should have gotten, or the pricing might be slightly higher for you because Fannie Mae wants to redistribute that money to the person that might not be as well qualified as you. How do you like that?
So yeah, it doesn't seem very fair. Now, I will say that I think there's a little bit of hyperbole happening here because I
There
see,
always is.
right? I mean, but I see people saying, "Oh, somebody with bad credit's going to pay less than the guy with good credit," and
Well,
that's not
that's not
really true,
true. That's
right?
not true.
But
What
they
it
are going to pay less than they would have a month ago.
And the buyer with good credit's going to pay a
Is going
little
to pay
more
more
than
than
they
they
would
would.
have. So
So
it doesn't matter how you slice it. It is taking from one to give to another. Now, whether you like it or not, this is well, our banter on this is not disputing whether it's good, bad, or indifferent. You can call Tom and I, and you can share your thoughts on that. Our contact information is attached, or you can call me on my radio show on WDBO on Saturdays or Sundays. Feel free to share your opinion. But let's face it, I find that the bulk of my business is not the 800 credit score putting 20% down. I help them every day. But the sweet spot, the majority of the people entering the market have a little bit of hair on them. Okay.
Same here. Yeah.
Right?
Yeah,
They
for
got
sure.
there's a little fuzz going on there, right? Their credit scores aren't quite as good. They're struggling to save money. They're the average working class family. And that's the bulk of my business. So do I want to help them? Yes. Do I agree with what Fannie and Freddie are doing? Well, I'm going to leave that up to you. That's not for me to judge because I'm here to help you whether you got a 550 credit score or an 825 credit score. I got loans for everybody.
Well, that's awesome. I do appreciate that, and I do know that you've helped a few of my customers get their credit scores up without going through lengthy credit, fixing kind of things. Just simple things
100%.
like, yeah, hey, follow this, do these 2 or 3 things, and in a month you'll have a better score. Matter of
Well,
fact, I took your advice a couple weeks ago. You told me to put my daughter on another credit card, and I did, and we got that credit card, and guess what? She's now a 750 from a 730. So I've almost got her to get the best
that's
rates.
fantastic. Here's one other thing you folks can do out there that are listening to this. If you are paying utilities, phone bills, cell phone bills, your power, your sewage, whatever it is, call the company that you're getting it from and ask them if they'll self-report. Because if you're paying those on time, now don't ask them to self-report if you're late on your power bills every month,
It
okay?
does cut
But if
both
you
ways.
pay it on time and you pay your cell phone bill on time, have them report. It's free and it'll help you boost your credit score up immensely.
That's awesome, man. That's great advice. Hey, Bruce, listen, man, we went a few minutes over. I have to go, but it was great catching up with you, and
Yep.
I'm sure I'll talk to you this week.
Yep, we're all here. And if you guys need Tom or I, we're right here for you. Contact information is attached. Over and out. Have a great week.
Yep. Have a great day.